Jim, let's open up the Cramer playbook
Right.
here. You're going on the road?
No, I got to tell you, the Cramer playbook, I'm going to Penn State. The Cramer playbook is simply a mimic. I wrote a whole book about the industry, you got to mimic big money. And I did that because one of the things that can happen is at various times the consensus, not the current consensus about oil going down, but the consensus about what happens in business cycles is right. And that's because you have to bet at a certain point with the Fed. That's the don't fight the Fed. The don't fight the Fed comes from this notion that the Dow Jones Industrial Average has gone from 1,100 when I started in 1981 to Dow, well, we went to Dow 14,000. All this has been done within the confines of the Federal Reserve cutting dramatically, then injecting a lot of liquidity, and then the market going higher. So those who are seeing Federal Reserve cutting dramatically and injecting liquidity recognize the pattern, and they start selling the stuff that is that has had big moves at the end. With typically commodity inflation. That's always been the end of the moves. You get commodity inflation. Fed then gets then the economy gets choked. Commodity prices come down. Fed starts easing very aggressively. Of course, the commodities actually held on a little bit more here because they're more global in nature. And then you get this exquisite moment where you have either a tremendous financial collapse, long-term capital, Mexico, Russia, or you have a confluence of events where you finally get rates so low that it flushes a lot of money in from the sidelines. We've got both. Cash is no longer giving you a very good return at all. We know T-bills are 0.5%. So that doesn't work against inflation. You take a beating against inflation with T-bills right now. And we also have a remarkable collapse of a major institution, Bear Stearns, seamless because Treasury got involved. I want to emphasize again that the playbook says to bet against the market here is suicidal because the big money is just looking and saying, okay, look, we've had those series of events. That means buy. It has never not been buy. So those who want to stay negative are betting that things are going to have to get substantially worse from here. I look at two things. There are two institutions I'm worried about, National City, NCC, and Citigroup. Nat City is small enough now to be swallowed up by Wells Fargo if there's a problem, and Citigroup is, without a doubt, so chock full of $40 billion worth of assets that Vikram Panda can peel off that I want to take off the table that survival. Why didn't I mention Washington Mutual? Washington Mutual has a tremendous asset base. I think that there's plenty of companies that would like to come in at $9, $10 with a stock at 13 and buy it. So even though there may be a rearguard action that says that Washington Mutual is no good, that's not big enough to trump the business cycle and therefore not big enough to trump the early cycle flows.
Got it. News from Cramer's playbook. Stick around.